Hello traders, in this playbook update we are going to be looking at the V-shaped reversal or key auction reversal as it is otherwise known. Now, being cryptocurrency traders, having traded Bitcoin, we know that we see these kind of moves quite often and they're pretty damaging for a lot of participants in the market. But for me, it's a personal favorite of mine to trade, and we're going to cover the theory that I have on what I basically believe to be the lowest risk and just the easiest way to trade these moves, which is actually after the move itself has happened a lot of the time. So you see so many people getting caught up in these really high volume moves and then being too scared to trade the subsequent price action that we get. But this is sometimes the most profitable period of time after you get these moves, because a lot of the participants have been either liquidated, stopped out, or are just sidelined through fear of like getting into the market after a big volatile move. But it's actually really straightforward once you get an idea and can kind of control your emotions in order to play the range that does form afterwards. So as usual, let's go straight into the playbook card itself and we'll take a look at the notes. So I have it set as an intermediate difficulty. Obviously, you've got to be able to identify a range and you've got to have your wits about you to know when one of these reversals has occurred. It's extremely effective because, again, a lack of participants in the market, it is building liquidity. So it's very often that once you get big volatile moves like this, it's unlikely that you will see aggressive continuation in either direction after that. It's more likely that you'll see a range that gets put in, so it can be very reliable, and it gives you a risk to reward on this particular trade itself of 3 to 1. So notes: a V-shaped reversal is a key a V-shaped reversal is a key tool in any trader's playbook. It is where the majority of participants lose the most money, but it will happen in every market and is an important part of price discovery and the auction process. This move will mainly happen on a move down due to the psychological nature of decreasing prices. The easiest way to trade a V-shaped recovery is to take advantage of the subsequent volatility whilst liquidity is restored and most traders are sidelined. You can trade these ranges in both ways and allow the market to determine its own direction in order to minimize your own risk. You would look for shorts at the top of the local range as well as longs at the bottom, with a target being the equal move up or down from the range itself. Alternatively, you can pick one side and build a position with an invalidation if price gets acceptance back inside the discount or premium areas of the range extension. It is a complex trade as you must be able to quickly identify the range, but it has very little risk and a solid reward if traded properly. Okay, so let's do the usual again and come back up to the top, and I'll just explain these parts. So what you're seeing here is an auction process on the move down, okay? You're seeing increasing volume and an accelerating move to the downside. So it's something that maybe starts off fairly calm. I can't even open my web tools. Okay, so watch the mouse. Something that starts just fairly slow and you get this increase in volatility, you get this increase in volume, and you get an accelerated move down. You have a volume climax at the lows, and then you have an equal and opposite reaction back up. So if this is a move down, then you get an equal reaction to the upside with just as much volume and speed in the move up as you got in the move down. And then it forms a range afterwards once things settle. So you're looking for this, basically the point in which this equal and opposite reaction gets a pause and you have a first reactionary low off of that. So often you'll see big move down, big move up, then a quick move down, and then it forms a range, okay? So what you are looking to do, and this is the way that I do it personally, is I will trade both sides of that range. Now, often, I'll explain this again a bit more, the probabilities of this do favor this to be a reversal. So this is why it is called a V-shaped reversal or a key auction reversal. Okay, so the longs would be in favor of this. However, you can still profit because it is likely that the sell side will reach a target first in order to basically build value and test that this is actually going to be support. So you can trade it both ways, but if you do want to only trade one side of things, the long option after a move down is better. There is a higher probability that this will play out. So basically, you're looking for the range to form. You would be selling the range highs. That's probably the first opportunity you'll get, and be buying the range lows if you have two accounts, or if you have an account that allows you to do both things. And that gives you a spread, okay, between the highs and the lows of the range. Then what you're looking to do, basically, one of these trades, or possibly both of these trades, will end up winning. So let's say, for example, you sell the range highs and price comes down into the equal move. So between this 0 and this 1, after you get the A and the B here, the 0 on the 1 on this, you would be looking for this equal move down to reach target of your short and possibly even add to your long position there. So maybe you want to sell in order to buy lower down and give yourself a better trade. You can do that on this. And then also you would be buying these range lows with the understanding that yes, maybe this long may go underwater slightly whilst this short reaches target, and then you can trade it again in the opposite direction. But the important thing here is you have a discount area and a premium area within this range that is formed. So if you stack your range on top of each other, anything double what has happened here, so this -1 would be price premium. Anything down, like double it lower down, so this 2 would be a price discount. And what you're looking for, if this is going to be a reversal, clearly we cannot come back into this discount zone. You have had one opportunity to buy this. It will form a range. It may test the edges of it, but you should not be going down into this area, or it is highly likely that we will get further continuation to the downside. The whole point of a V-shaped recovery, it is very important. Key auction is very important to the market, and you should not be revisiting these levels. Otherwise, it does more often than not lead to a more aggressive move to the downside. In the same part, if this is not going to be a key reversal, then you would not be going back into premium. Okay, so this is establishing that value is here. There is interest. This is why you've seen a climax in volume with a lot of aggression from both sides. There should be a balance here. And if you make your way back into premium, come at above this this -1, then you would expect continuation on that. So that is why if you are short from the highs, if you got acceptance into premium, you would close out of that and hopefully you'd be in a long at the same time. Or if you had bought down here and you get acceptance back into these lows, back into this discount area, that would be an area to close out of and to look again for lower prices. Okay, so once again, this is also going to help. Hopefully it would have a very narrow range after a big move down, because obviously otherwise it wouldn't really be a V-shape reversal. It would just be a bit of a slow move down if you're putting in a range that's very close to where the low is. Just by its very nature, you're not really getting anything like that. You want to see big wicks, you want to see a lot of volume, and you want to see a big move back up that gives you a range well above where the actual climax in volume was. So again, hopefully, as always in these videos, that does make sense to everyone. This might be something that you have to watch back a few times, or you may have questions. Again, please do feel free to ask if you do have any questions on this within the chat or wherever you are in order to get more information on this. But let's have a look at the move that we did have yesterday on Bitcoin. Okay, so I'm not going to go over any of the move down itself. We know why that happened. We're aware of why that happened. But what you see here is this auction down. Okay, so you see here you have this process of price going lower, increasing in volume. So you see increasing volume. You start low, the volume increases all the way down until we hit our lows here. So you see this increasing volume, you see this increasing velocity, and basically the parabolic move to the downside. Then what you see after this selling climax down here, after this aggressive selling has occurred, you then see aggressive buying with equal volume, okay? So yeah, it's very slightly lower on this occasion, but this is showing that right down at this lows, this is where you really see the fight, and then you get an equal move up. So let's have a look at this. We're looking at 1, 2, 3, 4, 5 candles down to get from this range, and then we have 1, 2, 3, a little bit of chop, 4, 5, 6, 7, 8. You see what I mean? It's a very, you get some symmetry there. It's an equal reaction. And then you put in a range that is well above these, where that selling climax and that increase in volume is. So that again is an important part of this. So the first thing you're looking for is an initial reaction, high and low. So you get the move down, you then get the move up, and you put in a high. You can see here a very easy to identify high, because you just have this move that comes up, immediately gets reversed, and then you put in your low. So this identifies your range. Okay, very, very clear on this chart. So you have move down, move up, you slope up to put in a high, and then you immediately come back down to put in your low. And then what you're doing after that is you're looking for shorts at the top of the range and longs at the bottom. Okay, so you'd be selling the highs, longing the lows, in order to get a target for an equal move up, so ×2 or ×1 of this range to the upside, and that would be your target for any longs. And then you'd have your target down here for any short positions that you have taken from the range. Okay, so it's quite simple. And what this does say is that down here, this is your discount. So price should not be coming back into this discounted area below this green line. That is where you have one opportunity to buy. It's a discount, it's a sale, okay? It doesn't last forever. And then above here, you have your premium. And your premium is where, if market participants are wanting to force this down further, we should not be coming back up here. Like, this is too high. There is a reason people have exited the market around here, and if price comes back and gets acceptance back up here, it is very likely that it will get continuation. So you have your discount, you have your premium, and you have your targets for both the long and the short position. Now, I'm going to run this along a bit, and we're going to have a look at what happened here, because it takes a while, so bear with me. You have your shorts, you have your longs, you have more opportunities for shorts, more opportunities for longs, starting to be able to build a position, and you can see here the midpoint, how that has been respected. Okay, so we'll continue scrolling along. This happened for a long time. And then here we go. We have finally our move below the range. You see it has a move below the range on fairly high volume, comes back in to test it, and then it initiates this move down to get a test at this point here. So it's kind of in no man's land, just chugging along here, not really doing very much. I will just squeeze this in a bit. And then you have the test. Okay, so obviously there were other reasons, other confluence areas for this. We know that there was a golden pocket within this region. We know that there was, I believe, a daily level within this region as well. But you have your test, and this is very important. You have a move down, aggressive selling here in to do this test. And the important thing now is that if you are in this long position, or if you're in the short, this is where you would look to close out of your short, because you're not expecting, you're trading a range here, you're not expecting to come back into discount and for this to get continuation. That's not the point of this. You would be taking profit at the very least on your short position and possibly closing it. And if you are in a long, you will be watching this very closely to make sure it quickly gets reclaimed. You do not want to see acceptance within this area. So you see heavy selling coming into it, and then immediately you get this buying pressure. So you can see all of these green delta candles after that showing that there has been immediately a rejection from this discounted area. And what happens? You come back in to test the top of the range, eventually break into it. And here we are once again back trying to hold within this range. Again, you see the midpoint here acting as this resistance. So this is the very important thing that hopefully you can see from watching this, is that you have your shorts, you have your longs. First of all, the sellers get their reward. And now we're possibly looking at this to go up to this area to test higher. If that cannot do that, then you would say that this auction process, this reversal has failed. And if we do come back down here again and we get acceptance, it is very likely that we see big continuation and lower prices on this. So yeah, I think that is all of the theory really from this. I can just quickly put on a couple of positions and we can remove all of these brush strokes and just add the positions just to show what this will be. So first of all, you would have your longs at the low of this range. Okay, so you see where that low has been put in with an invalidation down here and a target up here. And then you would have your short positions from these highs. Let's just move it along. Okay, we came up into these highs. Invalidation here. Target down here. So on this, each of these gives you this 2-to-1 risk to reward, but actually after these play out, the trade itself is more likely overall to give you a 3-to-1 because you're likely to win both of these trades and you're likely to get continuation after this. So you can see here are the two setups. This is what you'd be looking for, and any acceptance below, what you would simply do. So say price came down here, it got acceptance below this area. You would be looking to just go, okay, cool, longs cut, hold on to your short position because it's very likely that this is going to go lower. All right, so that would be, again, the way that I do trade this. There are other methods, and there are, of course, being a day trader myself, there are other methods in order to get in at these lows. But for the lowest risk, the easiest thing to trade, and just to take advantage of the range-bound nature that happens after a move like this occurs, this is the way that I would say is very good fun to trade. You often get pretty fast results, although in this case it's taken a long time. And yeah, it's just a range that you can trade. So yeah, thank you for watching this. I don't think there's anything else that I need to cover on this, but again, if you do have any questions, please do let me know in the chat or in any of the trading rooms, and I will be happy to explain this in a bit more detail. So yeah, thanks a lot, and I look forward to the next update next week. Cheers, bye.